equity, just like me. And it took almost everyone to get out of equities for the equities to give you a bull run of a lifetime, which was that almost all the excess of the corporate world had been cleaned up.
Right.
These companies were really cheap and available. We are going through that phase. I don't know whether it will take 6 months, 12 months, 18 months, but if you look at it from the cycle point of view, our cycle has slowed down, which is a good thing. And that we have to accept, that we will have a period of 12, 18 months when these corporates will have to take very tough decisions to sell businesses, sell assets. Some of them might go bankrupt, which is very rare in India though. But we'll have this period of cleansing which is going on right now, and that will take 12, 15 months. For us, unfortunately, we also have this election which comes in between, which actually distorts this entire cycle as such. So I would say that once we have the election and once this cycle is another 12, 15 months through, you will get a very good opportunity to go and invest in equity. Till then, you have to keep, actually just look at equities and keep it at the lower band of your portfolio as such. So that's my long-winded answer on that.
Naren, are you feeling relatively more optimistic?
See, I mean, if I take equities first as an asset class, what I find is the worst years to invest are years where both locals and foreigners are both investing heavily. That year was 2007, that year was 99, 2000, that year was 94, 95, and maybe 1992. So those are the dangerous years for investment. Now we are in a phase where in the last 1 week now, finally, FIIs have turned seller. Locals, I don't know whether it's the entire, locals seem to be buyer. Now, if in that environment is a better environment for investing in equities than an environment where FIIs are buyer and locals are seller. If I see the last 15 years, the best years for equity investment have been the years where FIIs have sold aggressively. That is 1998 and 2008.
And that's happening right now.
The worst years of investing have been 2007, 2010, 2012. These are the second half of 2009. In these 4 years, FIIs invested very big money, and those were the worst years for investment. So finally, now in the last 4 days, we have reached a situation where FIIs have turned seller. So we have reached a phase where you have to start buying. Now that's what is clear, and how long you have to buy, that's a question like Anup pointed out, whether you will have to buy for 1 year, 2 years, 3 years, that's a question which we don't have an answer, but we have finally reached the investing phase. We should be investing, we have to be continuously investing into this phase. The person who invested in 1998 in old economy, he didn't make money, then he invested in 99. Then he invested in 2000, 2001, 2002, and 3 onwards, he got all the returns he wanted. So we are clearly in that investing phase when you should be investing in equity. As far as fixed income is concerned, I think there is a big difference between fixed income and equity. Equity requires growth. If you don't get growth, you're not going to make money in equity. In fixed income, you don't require growth to make money in fixed income. Actually, the lower the growth, the better it is. But along with that, you can't have current account deficit. So if you have low growth and low current account deficit, you will make very good money in fixed income. So the challenges in making money in fixed income are much lower. All you need is the current account deficit has to come down to maybe 2% of GDP. I think today they pre-announced a number of some 3.8. Actually, the next quarter number will be much higher. And after that, it will start falling. So you have to wait to make money in fixed income, will take you maybe a year. It could make 1.5 years, but not very much longer. So the challenge in fixed income is to get people to invest now when yields are going up for the medium run, not necessarily for the long term. So that's the situation on the fixed income side. So essentially the good thing is that this is a period where investors should be investing for the long term without defining what is long, like Anup, in equity, and for the medium term in fixed income. This is the situation. Have we been in this situation for some time? Yes, maybe. But in equities, frankly, I was clearly waiting for FIIs to turn seller.
Sure.
And I just couldn't understand why they bought every day without fail for the past 2 years after
Sure.
August 2011.
Sure.
So the fact that they turned seller has made me much, much more positive on equities.
Sure.
Than because after August 2011, I was thinking we made so many mistakes, but FIs kept buying.
Sure.
Yeah, and people think if all the FI flows came after August, September 2012, when diesel prices were high.
Right.
But the flows between January and July 2012 were huge. So that's where I stand.
Sure. Navneet Vinod also joins us on this fag end of this conversation. Navneet, we've been talking all this while about what the opportunity has been there in the market so far, and what's the road ahead like. What's your own view on how you're feeling about the markets right now? Do you think the road ahead is going to be bumpy? Do you think it's a good time to buy? What's the sense?
So good time to buy is always when there is some kind of uncertainty in the environment, and there is a lot of uncertainty. I mean, stemming from the what's happening globally, the unwinding of the quantitative easing in Fed. But my sense is that within the emerging market space, I think India is likely to outperform because at the margin, macro is likely to improve here, which is not the case with several other emerging markets where the macro is likely to deteriorate. So whether you look at the current account, actually I'm extremely positive on current account. RBI just released the data for Jan to March quarter, but I think this is just beginning. Given the currency depreciation, I think the impact on exports is yet to be seen. We are going to see fall in imports. Given the fall in commodity prices due to the demand destruction in the rest of the world, I think current account is likely to significantly improve from here on, and that will have positive impact on fiscal and on inflation as well. Due to the currency weakness, the recent currency weakness, the expectations on from the RBI has gone down. But I think we are still in a down cycle in terms of economic cycle, and I think there is room for rates to go down. So of course the rates have moved up because FIIs have sold almost $4 to $5 billion, and it has impacted our market. But I think once the dust settles in next couple of days globally, I think hopefully the bond yield should start falling again. So that's a positive. Macro is likely to improve from here on, as I mentioned. Policy environment, I mean, we always perform whenever there is crisis. So we have again a crisis, rupee has crossed 60. So I'm more positive from the policy perspective. I think despite being an election year, I think it's highly unlikely that government will turn populist. I think we can expect a lot of measures from the government in the next couple of weeks. I think valuations are quite reasonable if you take a slightly longer term call.
Sure.
And from last point, I mean, liquidity flow wise, of course, we have seen selling from the FIIs. Of course, they have been overweight India given probably the relative attractiveness of India within the EM space. There has been outflows from the overall EM funds.
Right.
But I think again, longer term story remains intact, that our structural story is intact while I mean there are some cyclical problems. The rest of the world has got structural problems and trying to solve it with cyclical solutions. So I think flows will continue, and within emerging market, my call in next 1 year, even in dollar terms, I think we are likely to outperform. And domestic flows, that makes me more positive on market, that I think the domestic investors are significantly underweight equities. And I think June, another few days, I think most likely industries is likely to see after a long time positive flows from the retail investors. And I think if market stays at these levels, I think there are a lot of investors who have been waiting on sidelines to put money in equity. The relative attractiveness of other asset classes where money has moved, gold, real estate, is likely to fade. And once interest rates fall, I think there could be a big flow of money from the domestic investors into our equity market. Even in case there are some outflows from the global markets which can create some volatility, I think domestic investors will be able to, I hope that they will take the advantage of that volatility and get into the market.
Sure. On that note, I'm going to throw this open to questions to the panel. Anyone has a question, please raise your hand. The gentleman right here. Can someone pass a mic, please?
Hi. As Mr. Naren mentioned, from the last 3 to 4 years, retail investor has not invested in a cheap valuation. But unlike the AMCs, they have also focused on a fixed income rather than an equity side. They have a basket of debt side. They have launched credit opportunity. They have launched some dynamic fund. So don't you think there will be a much more room in the equity side rather than debt side?
See, the room will be there, but we have to remember the variability of returns in equities across the world has always been higher than fixed income. So I think there is room for both asset classes. The quantum of assets that you can collect in fixed income is, in my opinion, you have just scratched the surface. Whereas in equities, while the potential is very large, the risk of the asset class has always been higher. So I believe that while people today believe we have collected huge money in fixed income, actually you've collected a very, very small sum of money. And unfortunately or fortunately, what has happened, you've collected in the last 1 year. If you go back maybe 1 year back, the quantum that you have in fixed income today is much higher than what you had a year back. But I think the scope in fixed income is limitless, if you ask me. And I think we have only scratched the surface. Somehow today, after this recent fall or rather rise in yields, there is some worry, but honestly, you have collected very such small money that the opportunity, the fact that I was always worried that you shouldn't have a 2008 scenario. In 2008, what happened was the yields fell by 3% in 4 months. And thereby never gave an opportunity for retail to invest. And those people who invested retail, they invested after it fell to 5%. And then they had such a miserable experience. Whereas this time, the way the cycle is playing out, that for that long-term bottom of interest rates to happen is taking more time. Therefore, the opportunity for the IFA to collect money from the investor is much, much higher.
Right.
If you add a 4-month cycle, it is very uncomfortable in retail. Institutional investors can invest overnight, but retail, it takes time. And today, this recent fall in bond prices and has also will make the right investor invest, because somewhere I was worried that in the second half of May, people thought that in income funds also you will get 15% per annum. Now that will slowly, people will have a doubt. So the quality of sales that you will do from now on will be far better than what you did in the second half of May.
I just have an observation actually. So if you look at our industry, we have a great knack for killing any opportunity which emerges, because we don't want the other to grow. So if one fund launches a fund which does well, we don't want that to grow. We want to launch 5 other similar type fund to kill that whole category. I'm just worried about that part, because we've done that to equity for a business which I have seen for 20 years at 1,70,000 crores. I just hope we don't do that to fixed income, because I can't make out the difference between short-term income fund and a bond fund and a dynamic bond fund. And I can't, and I think so you guys are really smarter than me to figure out the difference between all these. And the poor investor whom you're trying to, again, convince that please go in dynamic bond and not in bond versus short-term income. I think so that's the real genius of our industry.
Let the gentleman at the end, please.
Genius is required there. I mean, short-term funds have maturity of 2-3 years, and a long-term can go as high as even 15 years. So there is a world of difference between.
Yeah, but all the long-term funds
also
also have a
fixed
maturity
income.
of 4 years right now, because they don't want to have a loss. So.
Yeah, gentleman there.
Just taking off from what Anup said, actually, if you look at the 1-month rolling returns for the last 1 year of the dynamic category and your long duration category, they're identical. In the average, I'm not talking about specific funds, some might have done better, some might have done worse. So, I'm kind of going back to what the CEO panel kind of talked about. They talked about product labeling and sticking to the product label. If in a dynamic fund, you're supposed to actually rapidly alter duration, I don't see any dynamic fund that is sitting at a 2-year duration today, which was at 8 years, maybe a month back. That's one big problem. And second, as an aside, Anup, I don't think elections matter. 2004, we saw what happened. We had the most disastrous election outcome, and see where the markets went by the end of 2004. Yeah, we had blips. I think elections are actually short-term phenomena that as investors, we should not be concerned about.
We'll take it offline, Sanjay.
I have time for one last question. The gentleman here.
Sir, my question to all the 3 panelists here, individually can answer. Well, last 3 years when we see import data, we imported oil, which is our necessity, and we imported a lot of consumer durables, telephone, mobile phones and all that, and did not import really machinery really. So our capacity expansion as a country has not taken a baby step also. Correct me if I'm wrong. So if the market has to go up, it has to only from a demand point of view, investor demand point of view, like FIIs will put money in India, which looks little difficult now. So what will be the real driver of a healthy stock market up movement?
You want to take it?
I think both. I think the real driver is you have land, labor and capital. In land, labor and capital, we made land very costly. Labor increased its price significantly after 2008. Capital became very costly. I think what I have seen for durable market, very big rallies, you need out of land, labor and capital at least two at low levels. If you go back to 90s, land and labor were very cheap ahead of the 92 to 95 boom. If you go back to the 2003 to 2007 boom, in 2002 interest rates were very low, land price was very low, and you had a situation where labor price was also very low. I think for a big, durable, big rally in equity, you need land, labor, capital, at least two out of these three to fall significantly. Why US recovered, you must realize, is because they had very low land prices, very low capital, and they got shale gas. So that was the reason why US recovered. So I think that is why the immediate